Welcome to the B.F. Anderson Technical Report for May the 17th. You know, the U.S. economy and the world economy is actually doing quite well, and I think it's interesting to note that interest rates are moving up. Here is the U.S. Treasury 10-year U.S. Treasury yield. So what we're seeing here is an uptrend in rates. Now we have finally gotten above the 3% area and are approaching 3.1. In fact, this morning I believe we did hit 3.1. Point being is this, is that if the economy was going into recession or we were seeing an economic slowdown, I don't believe interest rates would be moving higher. Now this is also probably an indication of inflation, and that'll be a factor. So if, all these fixed income strategies are going to start to have difficulty here, and I believe that that's going to be a potential amount of fuel for the stock market as people switch out of these fixed income strategies and move towards stocks, and I mean growth stocks. I really feel that this is going to be a tremendous amount of fuel, and I'll get a little bit more into that towards the end of the video. Now, staying with the theme of understanding the strength of the economy, I want to talk about something called Dow Theory. Now, Dow Theory was developed by Charles Dow in the 1930s, and basically what the general idea is that if the industrial index, now we have to realize now the market is a discounting mechanism. It's discounting the future. It's looking ahead. It's not looking behind. It's looking ahead. And so if the industrials break out to the upside, that means that there's a lot of manufacturing, that we have goods and services that are being provided. Now, if the transportation index does not confirm the breakout in the industrials, that's a really bad sign because it simply says, yes, we're manufacturing a whole bunch of stuff, but it's all sitting on the docks. So as we can look here at the Dow Jones Industrial Average, you can see the correction in February, consolidation, we broke the downtrend line, and if we break out above 25,000, this could suggest that we're getting ready to have an advance to new highs, which would be over 26,000. Now, let's look at the transports to just see where that confirmation comes in. So remember, 25,000 on the Dow would be a breakout from a consolidation for the industrials. Now, for the transports, you get the same basic formation here, consolidation, and a breakout above 10,800, and we're currently at 10,702, so we're only about 100 points away. But if we get a confirmation of the transportation index, that's going to tell us that we've got a Dow Theory buy signal, and that has always been a very good predictor of economic activity. So if you go back and think about the 3% 10-year Treasury, I'm of the opinion, and it's just my opinion, and I could be wrong, but I think there's a direct correlation with the 10-year Treasury yield with the GDP growth rate. So if we have a 3% Treasury, that to me would mean we're going to have a 3% GDP growth rate. And if we go to a 4% or a 5% Treasury, a 4 or 5% GDP growth rate, which is not out of the question. So the economy looks good. The market's discounting economic activity. Now, one other index that I would recommend we look at, now we don't use these indexes in our work. We use the 5 indexes that I've talked about in the past. I'll tell you real quick what they are. That's the S&P 500, that's the NASDAQ, the S&P 600, which is the small caps, then the S&P mid caps, and the New York Composite. Those are the main indexes that we keep an eye on. But this is the NASDAQ 100, which is the top 100 companies by size in the NASDAQ. So if we get a breakout on the NASDAQ 100 above 7,000, and you can see that, compared to these other indexes, meaning the Dow Industrials and the transports, this index is actually looking stronger and is very, very close to a breakout. Now, here's something I want to cover a little bit. Trend following is a great practice. I think it's a skill. I think it's something that we should all learn about. But along with trend following, there comes something called behavioral finance, which is where you study the behavior of investors, because this has a lot to do with where these trends come from. So if you understand a concept called recency bias, let me explain. Let's say you were 7 years old in 1997. Today, you're 28 years old. Let's say you were 55 years old in 1997. Today, you're 76 years old. So starting in 97 as a 7-year-old, now the reason I say 7-year-old is that is what the psychologist says, that people start to form their opinions. They start to have opinions starting at age 7. They're watching their parents. They're seeing what's going on. And, by the time they're 15, 20 years of age, they've pretty much decided about things. Well, if you were 7 years old in 1997, all you have seen using, this is, by the way, this is the value line geometric index, which is the average stock. So that all this 7-year-old has seen up until age 28 is bear markets. That's all he's seen. We got the 2000 bear market, then we got the '08 bear market, which I call depression number 2. In other words, if you take this entire period here, this has been an incredibly difficult period, and as a young man or young woman growing up, you have a bias. You have a bias against the stock market. Well, all of a sudden here, something has changed. We have seen a breakout to historic highs. And if you get a breakout to historic highs, you have to ask the question, what has changed? Well, I'd say interest rates going up. That would be one thing that's changed. And the other thing, too, this most recent quarter that we just went through or going through, S&P earnings were up 25%. That's one of the best quarters for earnings in history. So in other words, what has changed? What has changed is the economy went bad starting in 97, and it's taken 20 years to come out of this. And so what we're starting to see is a higher high in this index, which tells me something has happened. Now, the longer the base, the greater the race. So what we have to understand here is that these are patterns. These patterns go back to 1926 is what I went back and studied. So think about the same example of a 7-year-old and a 55-year-old, but let's say it's 1929. Well, your entire life, your money or your financial life, all you saw was depression. And I guarantee you, I still hear about the Great Depression. I'm sure by 1950, people were still talking about the Great Depression and how, Wall Street was a bunch of crooks and everybody jumping out of windows and so forth. But nobody really pays attention to the fact that the reason for the depression or the market collapse was because people were getting in too much debt. They were loading up on margin debt. You could use 90% margin back in 1929. So that's what killed the banks. We lost the banking system. It was a total disaster. So for roughly a 20-year period, but let's just say between 1930 and 1950, you developed a bias against the stock market. Well, lo and behold, starting in the 1950s, specifically 1954, we launched one of the greatest bull markets in history. And the market went up between 1954 and 1966, and I'm using the Dow here, approximately 400%. So let's take the other example. It's 1966. The market hit 1,000 for the first time. Did not get back above 1,000 again until 1982. Well, most people that went through that 66 through 82 period have a bias against the stock market. And so what then happens is 1982 to 2000 was one of the greatest bull markets in history, and the market went up 400%. These biases will get everybody in trouble because they're thinking too much. They need to realize that the economy goes through an ebb and flow. We're going to have a bad economy, we're going to have a good economy. So if we're looking at the same pattern here, what could that possibly mean? And I tell this to my friends, and they all tell me I need to go to the insane asylum. But think about it. If the past pattern repeats, the pattern of 29 to 50, the pattern of 66 to 82, if these patterns repeat, what does that mean in today's terms if you accept that it's not going to be different this time? It could be different this time. But that would mean that the Dow by 2030, the next, say, 12 years, could be over 100,000. It would be 125,000 at 400% from where it is today. So it's just something to think about. And you have to realize that, we're having trouble supporting this negative bias because the economy is starting to turn and look better. So the main thing is that fear and greed are powerful emotions. And, it's just something you have to understand. So let's get into the top five. I apologize for the size of the graph here. This is Axon Enterprises. I have to disclose that we own this stock. This is the old Taser. I was talking to a friend the other day about Axon. His son is a police officer and says that they just really like having these video cameras, and we can all kind of identify with this here in Baton Rouge, is what our police department has had to go through. And basically, this is a cloud-based technology that really solves a big problem for the video service of these police officers. Now here's Chipotle Mexican Grill. This is a turnaround situation, new management, stock is breaking out. Restaurant stocks are kind of looking good. In fact, we own one as well. We own Shake Shack. Here is a company called Ecopetrol SA, which is an energy company. We're starting to see the price of oil edging above 70 on the Brent crude, not Brent, West Texas. And it appears that maybe this is kind of a sign of inflation. Here's another petroleum, another integrated oil company called Petróleo Brasileiro. This is a Brazilian oil company. And we're starting to see where these emerging markets, that are really dependent on the price of oil, these stocks are starting to move. Here's a financial called SVB Financial. So basically, in conclusion, what I'm trying to say is keep an open mind. We have been through a 20-year bear market, very, very similar to the bear market between 1929 and 1954. It's very similar to 1966 through 1982. If the pattern repeats, and it probably will, we could see 100,000 Dow within the next 10 years. Let me know if you have any questions. Thank you very much.